MMTs, how are you doing? We're going to update the monthly chart on the VIX called Market Volatility Index CBOE. When this is at very low levels, traditionally and historically as always, it's a good gauge of the fear factor. Right now in the month of August, in the calendar 2012, today's date is 8/11/2012, we want to bring to everyone's attention that unlike at other times when this thing breaks higher, markets sell off. And you can see what happened in 2008. That fear level went as high as it could. Back here in 2011, when we were shorting, and we short the S&P 500 using index puts and calls, puts for when they have to correct, and calls when they have to go long on here. And there's lots of money to be made. I will tell you, as we approach calendar year highs on the S&P, and we can go higher, that on this monthly level, that back in 2007, this thing was at 10.33. It's at a major monthly support level right now. When this breaks higher, markets sell off. When this goes lower, and the lower that it goes, that's why we're at calendar year resistance highs in all of the indexes. When we had the last little bout of fear, we went from the same level here on a monthly level. When the calendar 2012 mid-year reversal levels happened and we were short, this was breaking higher. Now we can see where it tested that fear level, but now there is no fear. And people think that everything is just perfect. The lower that this goes, that's when a major turning point will happen in the S&P 500. So if the S&P 500, if you look at our index videos that we've done today, S&P 500 is in there, you will know one thing for sure, that we're hitting at major resistance levels with very low levels in the fear indicator. Once again, we would like to bring to your attention, in our market making options on indexes, we have special routing systems that compete with high frequency. They're all right here, okay? And they're used in the execution models when buying positions. I will tell everyone to utilize the SMF website. Go to high frequency trading courses as well. Click on there. Go to the trading platform. You're going to want to know that. Well, you're going to know why we're accurate. And we just brought the new website to all people. And our biggest concern is that right now we're very complacent in the markets. We have all our live coverages here every single day. We trade the market every day, all day. We're in the month of August. We're at the very low levels in fear, right about the time forward looking that something major could happen. Now, is it really the fear of the people? There aren't that many humans involved in the market as there once was. These high-frequency trading programs and algorithms drive these things down to this level. So back in earlier stages in our lifetime, just so you know the differences, is back over here in the 1990s when we were using it all the time. When these things break higher, markets go down. They did not have a lot of any high-frequency trading in here. It was really basically all humans, and it was more of a human behavior gauge rather than a manipulated high frequency, ultra high frequency trading applications that run these markets in one direction or the other. But what is the fear level? Is it really human? Nope. Not like it was over here. So I wanted to cover what the 90s were like. I wanted to cover, and I was involved all the time through all of these years, and this whole thing, when we peaked up, the financial crisis hit the bottom when we peaked on the fear indicator at 90. And that means that that's when markets put in bottoms. When these things reverse and go down, markets put in bottoms, and it's time to buy the call side of the market like always. When this side of the market gets so complacency, that means that the put side of the volume on the indexes are cheap in the volatility index. We would like to inform you outside of our MMT and our other educational programs is that we do have a tab over here called the VXN and topics thing here. So hopefully it will navigate correctly where you can use it right here, okay? And you can get your updates there, okay? We have given the broader perspective from 1990 using the VIX to trade long and short the S&P 500, and we were here then and we're here now. And the world changed through these years, and it's changed significantly in high computing program cycles that are used in indexes and exchanges, and the world has really changed, but we're here to show you what those changes are. And we're going to be buying the put options. The lower that this goes, the less fear. That means that corrections are around the corner. And the reason why we're looking at this on the monthly level now is because if we run up to challenge higher highs in the S&P, they can drop this thing right down here, and it would not be unheard of, but I can tell you what, that's right about there, right from where an all-time breakout occurred on 2/1 of 2007. Look at that. And the markets were tanking and put options were paying big. When did it happen? It happened in February on the monthly level. So this is a lower support level. The lower that we go, the harder it will be to get above higher resistance levels in the S&P 500. Being in the dog days of August with lower, lighter volume is going to skew these a little bit, but the same outcome of knowing what side of the market to be on. Hey, when this was going down, it was great to be on the call side of the market for the rally. But now that we're going to get down to these levels potentially on a monthly level, this rally could be running out of steam, because no matter what will happen, there'll be a major market change. We have a high alert with less fear in the market at a topping 2012, calendar 2012 highs across the board and all indexes across the board, and very low fear indicators across the board.